All right, good morning, everyone. It is 7:38 on the morning of February 21st, 2023, and this is my strategy session, my pre-market strategy session. Okay, so the title of the video is lots of economic data this week. What does the Fed do? And really, that is the big game when it comes to investing and knowing which way the trend is going to go. It's all about front running the Fed. Here, let's just kind of take a look back here. Let me go to the monthly, I guess. Go to the monthly chart here. Let me open that up. And so, let's see, is this 20? This is the 2020 dip right here. So, leading all the way up until I think it was this point right here, yeah, in 2018. The Fed was had easy rates, and then the Fed started to tighten rates right here in 2000. I believe this was late 2018. Yeah, it was. And as the Fed started to tighten rates, they announced they were going to tighten rates back here in roughly September, and they tightened rates going into December of 2018, and there was a 23% drop in the market. This is the Qs in particular. There's a 23% drop, and so then the Fed said, "Okay, well, we're going to take it easy on rates, and we're not going to raise rates again." And then the coronavirus pandemic struck, and that hit the markets because of the shutdowns. And then what little tightening the Fed did, it dropped to zero immediately. It dropped its rates to zero, and the Congress passed a stimulus spending bill, and that led us up into this incredible rip right here. Let's see, what was the percentage on that? For just the first 1, 2, 3, 4, 5 months, wow, after the pandemic and the shutdown hit, there was let's go from the bottom of the first month after it was announced. There was a 59.56% run up. Oh, we call it 60.57% run up in the Qs. And then the Fed again kept rates easy, zero, all the way up until the point here where they're announced, I think it was in August of 2021, we're going to start tightening. We're going to start raising rates. And then you can see there was a little stumble there in September. And then November was the high. That's when the raising rates was enacted. Rates started going higher. And now here we are in this, I think this is a 35% correction so far. Let's see. Roughly speaking, let's go from top to the very bottom. Well, that's a 37.79% correction, or actually, that's not a correction anymore. Corrections are usually somewhere around less than 20%. But so I'm going to call it a correction. I'm going to call it a pullback. I don't know, whatever you want to call it, right? And this is the reaction to the Fed announcing that it's about to get hawkish on rate hikes, meaning hawkish, meaning they're more likely to raise rates, and all the way up until the point where it's saying, okay, well, the Fed is looking at, raising rates at a slower pace. So it's not, the Fed isn't as hawkish. And here we're starting to bang out a bottom now that everyone thinks that the Fed is getting close to stopping the rate hike cycle that it's doing right now. And they're thinking roughly 5.5% is where the Fed is going to stop hiking rates. Now, I believe, and this is, let's see, Fed funds rate. I think there was a recent 50% or 0.5% Fed rate now hike recently. So the effective rate is 4.58. I've forgotten exactly what the Fed has it pegged at. It might be 4.75 by this point. And so there's a percentage point to go until the Fed is done, roughly a percentage point to go until the Fed is done hiking. And so less hawkish is more bearish. And it's my opinion, this is my opinion, that the market starts heading up based on the Fed sort of backing off on rate hikes, getting more dovish. But then recession comes in, things start selling off. Maybe the Fed backs off a little bit. Basically, the whole gist of the data that's coming out is to front run the Fed. What is the Fed doing? If the Fed is still tightening, well, then maybe you can buy through here until it's done tightening, and we can get a run up. But then economic data, there are layoffs, there's blah blah blah. It's going to cause the market to come back down again. And the Fed's going to start cutting, and that's going to everybody's going to want to front run the Fed on the cuts, right? So where are we this week? Basically, how can you trade it, right? Well, so we've got S&P Flash Services PMI Feb coming out in February. This is, this is the Chicago. This is the non-manufacturing PMI. So this is the purchases, or this is the services PMI. This is really interesting. Here in January, this is the January read. It bounced up to 55.2, which is great because a vast majority of the U.S. economy is based on services. And I really can't remember the percentage. I mean, where manufacturing used to be well over 50% of the U.S. economic output and sort of the driver of the U.S. economy, it's now services. And I've forgotten the weighting, but anyway. Services did take a drop just below 50 into contraction territory here in December, and it has since bounced up. So we're going to get that reading. Let's see, services PMI tomorrow, and it's supposed to come in at 46.8, back into contraction territory. So tomorrow at 9:45 will be an important time of the day to keep an eye on, because if we go back into contraction territory, there will be a pullback in the market based on that, especially in tech. Since tech is so heavily services, there are very few tech companies out there that are actually manufacturing companies now. The vast majority of the rest of tech is solely service-based. So, like for example, Intel, AMD, Tesla, those are actual companies that manufacture tech products. The rest, in the vast majority of the rest of tech companies are services companies, making people's lives easier or helping them get their taxes done faster, who knows what, All right, so kind of an important number here tomorrow, and a negative read will be kind of a big deal. And then we have the manufacturing PMI. Now, manufacturing PMI here is already in contraction territory, and it's forecast to go 46.9, and the last reading was 44, so it's actually forecast to go up a little bit. That won't be as much of a driver for a move on the market, since our economy isn't as manufactured based. It won't be bad for it, but it won't be as good as if non-manufacturing read higher. And that's a big move down for non-manufacturing. 46.8 from 55 to 46. That's that's a 15, roughly speaking, that's a 15% move to the downside. Yeah, that's gonna be tough on the markets tomorrow, in my opinion. All right. Then what's coming up? Existing home sales, it's estimated at 4.02. I doubt that. I think that's probably going to be a miss. Kind of whatever. Okay, so Q4 GDP. This is last year's GDP, and this is really very backwards looking. It's forecast at 2.9%. That's not contraction. That's actually decent. If we actually come in at 2.9% on GDP, that's okay. That's okay. And then Friday. Friday's going to be probably what moves the market the most, because this is going to be what predicts the Fed's behavior the most. So we've got consumer spending, personal income. Consumer spending is forecast to go down 0.2%. Personal income is forecast to go up 0.2%. So there could be a higher savings rate coming for us. PCE 0.1%. That's higher. Core is 0.3%. Year over year is 4.4%. All of those numbers are actually pretty good. The year over year at 4.4% is a significant down move from its recent 6.4% or 6.5%, something like that. So, and consumer sentiment is at 66. That's kind of low, but still it's above 50. I think normal reading, I mean, when the economy is really hot, this thing reads in the 90s. When it's really cold, or the economy's doing really badly, this goes below 50, and that's really bad. Yeah, you know what? I think Friday is going to be probably, if these numbers come through on Friday, this consumer spending nominal, personal income PCE index only at 0.1%, and then core at 0.3. It's not bad. And then year over year at 4.4. Friday could be a very big green day. Okay. So where are we on the charts here? So let me go back to the daily here. And the way I'm seeing things is right now, I did take this level off. This is a gap level between February 1st and February 2nd. The chart gapped up here. You can see this gap. And since then, the Qs have come back and closed that gap. So this gap really isn't, this level as far as a gap goes is not very, it's not relevant. Right, it's done for, this gap, but I still have it there because there does seem to be a little bit of a point of support and resistance right there at the gap. Today we're going to open up at Friday's lows. This, if it's hard to see, there's this pre over here 298.28, and the low on Friday was 29.10. So if I were to guess, I would guess that we're probably going to search for lower prices this week, and then I think Friday's going to turn. I don't think it's going to turn the week around, but I think that there's going to be kind of a turnaround toward the end of the week, and we'll continue this leg up right here after a little bit of a pullback. This is my opinion. So I think we had like a 20+% run up to this yellow line right here, then this pullback. Could go somewhere in this area, and then Friday, it wouldn't surprise me to see it come back up again. So that's my prediction for this week. Kind of a pretty rough start, but then Friday is going to kind of pull people back into the market if the Fed has reason to be less hawkish, and if the Fed can claim soft landing. I mean, really, if if the economy keeps on trucking, which is it will, the economy is going to keep on trucking. I mean, it really, the American system of capitalism is strong. We do a good job in making money and products and so on and so on. So, a little bit of a pullback here after this big run, pullback, and then we'll take back off again. That's my opinion. So generally speaking, I am still bullish. I think that I will probably wait until the end of this week. I still have a straddle on around 303. I still have a straddle. I have puts to the long side. They expire in April with calls. I'm sorry, puts. I'm long both puts and calls, but I'm straddling 303 with the same number of puts and calls around it. And the idea is for it to dip low enough. And if we get down into 295, then it will have dipped low enough for me to be able to profit on the trade 100%. I'll have been able to cover the cost of my puts, or I'm sorry, I've been able to cover the cost of my calls with my puts enough to have gleaned a 100% return on the trade, which will be very nice. It'll be a nice little sort of feather in my cap, but also payday. So looking forward to it moving one way or the other. VIX is popping up a bit here. I guess this week. You're not supposed to chart the VIX, but I do anyway. So I have this big red line going right here. So if we get up into the upper mid 20s, that'll be great for me personally. And then I'm looking forward to it dropping down again. And I think this is all going to kind of culminate onto Friday. Bitcoin is doing an amazing job here. Really surprised me. I was not at all expecting this move, and this is over a 50% move since its bottom of since November of last year. So just 3 months ago, let's see, November, December, January, and into February, 3.5 months ago. If you were buying Bitcoin down here, good for you. I'm glad to see that you are making money in this, because this is an insane move. Gold, personally, I think that we are on the other side of this bull move in gold. This is Sucker's Rally. This is what I've been saying kind of the whole time on the way up, although I couldn't tell you where it would cap off. I've attempted to trade gold in the past, and it is always, I wouldn't say always, but I have very rarely made money trading gold. Gold is one of those things where you buy into it when it's low, and you just wait a few years. I mean, really, and you average in over a rather long period of time for gold. It is not my thing. It used to be. I used to be this huge gold bug, and it is no longer really. I think that in the long run, in say 50 years, gold will be much higher. But as I still do have some gold holdings, but very little. And I'll probably, after gold corrects again and comes back down into the 1100 area, I suppose I'll probably look to add to my position in gold. Not until then. 2-year, 10-year, still half an hour before the bond market opens. Right now, it's at negative 838. The bond market always gets it right. The bond market always gets it right. The bond market right now is predicting a recession. And there's no doubt in my mind we are coming into a recession. The doubt that I have is previously in the past 3 inversions, as the curve, the 10-year, 2-year normalized again, we saw crashes on the market. Now, if history is any indicator, we're doomed to repeat this crash again. I do think there will be a pullback. But the actual gigantic, these were like 50% crashes back here. Crazy, enormous. Actually, on the Qs, it was like a 90% crash. Huge crash. Does it happen the same way this year? I doubt it. I think that we will normalize, of course, again soon. Within, say, the next, we're going on 8 months into this inversion. And historically speaking, the inversion lasts anywhere between 12 and 18 months. This yield curve inversion, if history is any indicator, has anywhere between another 4 to 10 months until it starts to normalize again. When it normalizes again, I do believe we will see a pullback on the equity markets. Will we see the same kind of crash that we saw back in 2001 and 2008? Something tells me no. Something tells me that we're not going to see the same kind of crash. Let's see, here's 2008. And from top to bottom on 2000 and 2008, 54% pullback in 2008. Let's go over to 2001. The 2001 crash was crazy. This is the one that I think is, this goes lower. Let me get volume out of the way. This price goes lower, so it's an even greater move down. It's it goes past negative. So this is 50%. This is negative 72%. So all the way to the bottom here, and I think that was September of 2002, negative 100%. It's crazy, right? So complete flip from top to bottom. 83% total, negative 100 if you'd bought in like the day the Qs opened. Insane. So do we see that again? I don't know. I kind of doubt it. I kind of doubt that although we are likely to see a pullback, I think we're going to see a pullback from the run up. But like new lower lows from the pandemic lows? I don't think so. I think it's going to be a big buying opportunity when we get down. Whenever this yield curve normalizes again, let's see where it is. Where is it? Whenever this yield curve normalizes again, it takes anywhere between 6 months and a year for the bottom to come in on the equity markets. And so if after 6 months you start buying in increments, you're looking at a year, another 6 months, possibly another year until the bottom comes in. So if you're buying during that downturn, that trough, and you're buying through the bottom, and then you look for the way back up, you're going to make money. This isn't going to last forever. This will pass. This yield curve inversion and then Q's dip and so forth, it will pass. And eventually everything will start to recover again. And as long as we don't blow ourselves up with a whole bunch of nuclear weapons, then everything's going to be okay. Everything's going to be all right. So that's pretty much what I'm looking at this week. And I'm looking to take profits this week on that straddle that I have, and then I will be at the end of the week looking for opportunities to get along on Friday. It's in my opinion. All right, everybody. Good luck out there. Keep your wrists tight. Click like, share, subscribe, leave a comment, tap the bell. Thanks for tuning in. I will see you at tomorrow morning's strategy session. I am out.